students, welcome to my live teaching learning session of BECC 131 Principles of Microeconomics. In today's session, we will discuss about Unit 10, Block 3, Theory of Cost of Production. Till now, we have discussed all the topics of principles of microeconomics like scarcity and choice, theory of demand, elasticity of demand, theory of supply, elasticity of supply, utility analysis, in which we have discussed cardinal approach, ordinal utility analysis approach, which was presented by G.R. Hicks and R.G.D. Allen. After that, we have discussed theory of production, short run law of production, and long run law of production. And today is the main topic, which is related with the cost. You know that when we produce goods and services, then we must have to put some cost of production, because without using cost of production, without discussing this concept, we can't produce any type of goods and services. So in today's session, we will discuss about Block 3, Unit 10, Theory of Cost of Production. In this unit, behaviors of cost curves, we will discuss like derivations and properties of short-run total cost curve, average cost curve, marginal cost curves, short-run cost curves, and what is the relationship between short-run cost curves and long-run cost curves, and what is the meaning of different types of cost, and simple words, what is the meaning of cost. Now, introduction is that cost is the basis of many important decisions. Cost and revenue, these are two main important factors, and cost is generally occur while producing goods and services. When we produce goods and services, then we use factors of production. Factors of productions are basically of two types. One is primary factor and other is secondary factor. Primary factors are those factors which are very necessary to use for the production of goods and services, like land, labor, capital, entrepreneur. These four factors of production or means of production are known as primary factors. And secondary factors are those factors in which we include raw material, fuel, and equipments, and other material which is used for production of goods and services. Whenever goods are produced, we must have to use factors of production, and in this process, the cost which incurred in the production of goods and services, that is called cost of production. Cost and output relationship is called cost function. Cost function mainly describe the functional relationship between cost and output. And what are the determinants of cost of production or cost function? There are two determinants. One is production function. You know that production function shows technical relationship between input and output. And prices of inputs also affects cost of production. If price of inputs are more, then cost will increase. If price of inputs are less, then cost of production will also decrease. So cost function mainly determine, or cost function determinant factors are, one is production function and other is prices of inputs. And cost of production we can calculate by using this formula, like total expenses incurred plus normal profit expected by producer. You know that each and every producer hire all the factors of production like land, labor, capital, entrepreneur for the production of goods and services. The reward for using land is rent, and the reward for using labor is wages or salaries, and capital reward is interest, and entrepreneur reward is profit. If we include all these, if we add all these factors of production's reward or their income which accrued after giving their services in the production of goods and services, is called cost of production. So cost of production provides basis of a product pricing, and firm's overall profitability is determined by the level of cost relating to revenue. Revenue is different concept. Revenue occur after using cost of production. When we use cost of production, when we include all the factors of production for the production of goods and services, when we sell this output in a market, then revenue concept will occur or exist. Now, next is types of cost. There are two types of cost. One is short run and other is long run. Short run is that time period in which some factors remains constant and others are variable. In short run, we have very less time period, so that we can't change all the factors of production simultaneously. Like land is a fixed factor, capital is a fixed factor, but labor is variable factor, raw material is variable factor, fuel is variable factor, and other things except land and capital, which is related with fixed capital, all factors we can change in short run except fixed factors. So short run is a time period in which the firm can varies output by varying the amount of variable factor, for example, labor and raw material. Now next time period is long run. In long run, as it is clear by its name that long run explain that we have too much time period, we can easily change all the factors of production simultaneously for the production of goods and services. In long run, there is no one factor is called fixed. So long run is a time period in which the quantity of all factors of production, such as all variable factors and as well as fixed factors, all can be changed. For example, capital equipment and plant and land, buildings, etc. The all factors can change or vary according to the desired level of output. So these are mainly two types of cost. One is short run cost and other is long run cost. And what is the meaning of cost? Cost means the money expenses which incurred in the production of goods and services is called cost. Next is cost of production. Now, cost of production explain that a firm always want to minimize the cost and maximize the profit. So cost function of a firm shows the minimum cost that the firm would incur in producing various levels of output. In economics, there are so many types of cost. And generally, we can explain types of cost. We include two types of cost. One is explicit, which is known as direct cost or money cost, and other is implicit. Implicit means indirect cost or indirect, and it is invisible, which can't be seen, but this cost actually occur while producing goods and services. So explicit cost are those costs which is actual out of pocket expenditures of the firm to purchase or hire the inputs like land, building, machines, equipments, labor, capital, etc. It requires in the which require in the production of goods and services. So it is clear by its name that direct cost is that cost which we have to use directly for the production of goods and services. And we must have to pay direct amount after hiring their services. Implicit cost is known as indirect cost. Indirect cost refers to the value of inputs owned and used by the firm in its own production processes. For example, if producer use his own land for the production of goods and services, he will not pay directly rent to himself or herself. So, in this case, he will not pay rent to himself, but if he hire land from other sources, then he has to pay rent. So, this is the cost, but not visible. That's why it is known as implicit cost or indirect cost. If any factor of production used by owner of the company or any business entrepreneur, if he use all the factors of production by their own resources, then he will not pay directly to himself. But if we hire these factors of production from outside or another sources, then he must have to pay amount to the hired factors. So that is called implicit cost. Implicit cost is indirect cost and explicit cost is direct cost. Direct cost means if you hire land, then you must have to pay rent. If you hire workers, then you must have to pay wages. If you hire interest borrowings, then you must have to pay interest. That is called explicit cost or direct cost. Next is cost of production can be divided in different types of cost like money cost, real cost, opportunity cost, total cost, average cost, marginal cost, and explicit cost, implicit cost, social cost, private cost. There are so many types of cost. Now, one is short run cost function. Number one is short run cost function. Basically, we can divide cost function into two parts. One is short run cost function, another is long run cost function. Now, short run cost function, this explain that cost function generally explain the relationship between input and output. Short run cost function explain that we use capital, land, and factor prices, technology, etc. remains constant, and hence short run cost function can be written as that cost is the function of input or various inputs like capital and land and technologies and other factors. Total output is represented by Q. So C is cost function or cost of production, and F is the function of output. K bar means capital, which is fixed. P bar is price of factors, which remains fixed, and T bar is technology, which is already given. So short run cost function, economics generally treated cost function of output both in short run and in long run. But we know that in short run, some factors remains constant and others are variable. So we cannot change fixed factors in short run. If we want to increase the output level, then we can change only variable factor units, not the fixed factor units. That's why in short run, only variable factor units can change with the existence of fixed factors. Now, next is short run fixed cost, variable cost, and short run total cost. In short run, there are so many types of cost like total cost, total variable cost, total fixed cost. Variable cost is that cost which can vary, which can change according to the level of output. Fixed cost is that cost which remains always fixed. It will not change, either output will rise or fall. So fixed cost is a cost which won't change with a change in the level of output. But variable cost, which is clear by its name, that variable which can change, which can vary. So variable cost is the cost which changes with the change in the level of output. And total cost is the summation of fixed cost and variable cost. So total actual cost that is supposed to be incurred to produce a given output in short run, that is called total cost. Examples of fixed cost are like building, rent, insurance charges, etc. And examples of variable cost is like cost of raw material, wages, electricity, telephone charges, etc. These are known as variable cost. And total cost, we know that it is the sum of fixed cost and variable cost. So total cost can be calculated by adding total fixed cost and total variable cost. So these are three short run costs like fixed cost, variable cost, and total cost. Now next is implicit cost. Implicit cost is also known as imputed cost or indirect cost. They are the costs which are not actually incurred but would have been incurred in the absence of employment of self-owned factors. Generally, implicit cost considered as self-owned resources cost. These are unrecognized by the accounting system. For example, rent of own building, salary for entrepreneur, etc. are the examples of imputed cost or implicit cost. Now, next is explicit cost. Explicit cost is known as paid out cost or direct cost. These costs are generally refers to those expenses which are actually paid by the firm. It appears in the accounting book. Direct cost can be visible, can be seen, and we can show it in accounting books. That's why this type of cost is called direct cost or explicit cost. Now, next is sunk cost. Sunk cost is that cost which can't be achieved. Sunk cost is the cost which can't be recoverable. If you spend money on advertisement or publicity for encouraging the sale of any commodity, but after putting this advertising cost or publicity cost, the sale of the product is not increases, then what will happen? You have put the cost on advertisement or publicity that can't be recoverable. That type of cost is called sunk cost, which can't be recoverable again. So they are not altered by a change in quantity and can't be recovered. All the past expenses are sunk cost. For example, depreciation cost, interest, machineries which are not in use, that type of cost is known as sunk cost. Sunk cost means which is sunk, like Titanic ship sunk. That cost of that ship can't be recoverable after sinking in a sea. So sunk cost is that cost which can't be altered, which can't be changed, and which can't be recovered. Next is private cost. What is the meaning of private cost? Private cost is that cost which incurred by the private and which incurred for the production of goods and services, and this type of cost bear by private entrepreneurs or private corporate sectors. So private cost of production can be measured in two ways. One is economic cost and other is accounting cost. Economic cost is the cost of all inputs used to produce any goods and services. Economic cost formula is that explicit cost plus implicit cost plus opportunity cost. If we add all types of cost, then we can get economic cost. In economic cost, we can include direct and indirect cost both. Explicit cost, you know that direct cost in which cost which is paid in cash, and implicit cost is known as self-imputed resources cost, imputed cost of self-owned or self-employed resources based on their opportunity cost. But in accounting cost, we can't include implicit cost, because implicit cost we can't maintain it in accounting books, which can't be maintained in accounting books, that can't be included in accounting cost. So in accounting cost, we always include only direct cost, which is visible, which can be seen. But those costs which can't be visible, which can't be seen, that will not be included in accounting cost. But in economic cost, we can include explicit cost, implicit cost, and opportunity cost. And what is the meaning of this cost theory? Cost theory generally explain all types of cost, and it also explain different time period cost functions like short run cost function and long run cost function. Total cost is that cost which is the summation of total fixed cost and total variable cost. Total cost refers to the sum of all the cost for each of the input used in the production process. In the short run, SR is short run. In the short run, total costs are classified into fixed cost and variable cost. Fixed costs are those costs which incurred on fixed factors of production like land, building, machines, plant, etc. And variable cost occurred in case of variable factors. So variable cost can be changed according to the level of output, but fixed cost can't be changed according to the level of output in short run. So the difference between fixed cost and variable cost exists in only short run, not in long run. Because in long run, we have too much time. In long run, we can change all the factors of production equally or simultaneously. That's why in long run, there is no difference between short run, between fixed cost and variable cost. All costs are known as variable cost in long run. So fixed cost is that cost which incurred the fixed factors cost It includes cost of machinery, equipments, cost of land, cost of building, etc. Now, this is the diagram of three cost of short run, like total fixed cost, which is presented by TFC. T means total, F is fixed, C is cost. Next is TVC. TVC shows total variable cost, and TC represent total cost, which is the sum total of fixed cost and variable cost. In this diagram, on x-axis, we will write output, and on y-axis, we will take cost. You know, output, while producing goods and services, we must have to incur some cost of production. So these are three major costs, like total fixed cost. You know that fixed cost in short run remains always fixed. It can't be changed or altered according to the change in level of output. That's why fixed cost curve is always horizontal or parallel to the x-axis. TFC will not start from the origin because TFC can't be zero. If you purchase building or if you purchase machines, equipments, it means you have spent money. It means cost can't be zero at that time. That's why total fixed cost can't be zero. It will always start from at a minimum level or this like 50. Total fixed cost can never start from the origin because fixed cost can never be zero, and fixed cost remains always fixed whatever level of output you are producing. Either you are producing more or less, but fixed cost can't be changed. Now, variable cost curve always start from the origin, and its shape is always reverse S shape. And TBC generally start from the origin. In the beginning, cost falls. After that, cost will become minimum, and at last, cost start rising. As well as output increases, cost also increases. So, total variable cost varies according to the level of output. If output increases, cost increases. If output is less, cost will be less. Like variable factor like labor, raw material. If you want to produce more, then you more use labor and raw material. It means cost of variable cost will rise as well as output rise. If output is less, variable cost will be less. And if you are not producing any good, if output is zero, then obviously total variable cost will be zero. That's why total variable cost curve always start from the origin, and its shape is always reverse S shape. And this TVC shows that as well as output increases, cost also increases. Now next is total cost. Total cost is the summation of total variable cost and total fixed cost. That's why if we add TVC and TFC, then total cost will remain always higher than TVC and TFC, and it always start from the that point where total fixed cost curve is a horizontal line, because the uh, first level of total cost we can take as a total fixed cost, because total cost curve origin point is same as total fixed cost curve origin point. That, and it's also a reverse S shaped curve, and it always parallel to the TVC curve, but can't intersect to TVC and can't touches to TVC, but it may be parallel to TVC. So TVC is also reverse S shaped curve, which also varies according to cost will also change. The change will which happen in total cost is called marginal cost, and the calculation of marginal cost is we can calculate by using the formula like total cost TCN minus TCN minus 1, and other formula is delta TC upon delta Q. Now next is This is the shape of average cost curve. Average cost curve is always U-shaped curve, and average cost is known as per unit cost of output. What is AC? AC is the per unit cost of output, and AC can be estimated by using this formula AFC plus ABC. Same as total cost, like total cost is the sum of TFC and TBC, but average cost is the sum of AFC and ABC, because this is the per unit cost. That's why we take per unit fixed cost and per unit variable cost for calculating this per unit cost. And TC is the sum of TFC and TBC. And in each diagram, we will write output on x-axis and we will take cost on y-axis. So this is the AC curve, which is always U-shaped curve. In this diagram, here cost is decreasing in the beginning. After that, at certain point, at this minimum point, here cost is very least or very minimum. At Q2 point, cost is minimum, and after that cost curve start rising. That's why we can say that cost curve is always generally U-shaped curve due to the applicability of law of variable proportion. And AC is also the summation of AFC and ABC. That's why its shape is always U-shaped curve. The two reasons behind this U-shaped curve is one is law of variable proportion and other is AC is the summation of AFC and ABC. That's why AC curve is always U-shaped curve. Now first law is variable proportion. You know that in the beginning production increases. When production increases, cost will start decreasing. When production is maximum in second stage, then cost will be minimum at this point. When production start falling in third stage, then cost start rising in third stage. So production and cost are inversely related to each other. Production curve is always reverse U-shaped curve, but the cost curve is always direct U-shaped curve. So this is the logic behind the U-shaped AC cost curve. Next is AFC. AFC is always downward sloping curve from left to right, same as demand curve. It's also known as rectangular hyperbola curve. Rectangular hyperbola curve is that curve at which elasticity of demand remains always equals to 1 at each point on this curve. Like here, 3 points is mentioned on this AFC curve, like A point, B point, and C point. At all these points, elasticity of demand remains always equals to 1. That curve is known as rectangular hyperbola curve. So AFC curve, why this curve shape is always downward sloping curve instead of a U-shaped curve and other type of curve? You know that TFC always remains constant or horizontal. Uh, Either we produce more goods or less. And AFC is per unit cost of fixed factors. Per unit cost of fixed factor, when we calculate by dividing TFC to Q, then it will always diminishes. That's why its curve slope is always downward sloping curve, which represent that as well as output increases, cost will decrease. But AFC curve will never touches to x-axis, will never intersect to x-axis. It may parallel to the x-axis, but never touches and never intersect. And its shape is always downward sloping curve from left to right, and its other name is rectangular hyperbola curve. Now next is relationship between AC and MC. You know that AC curve is always U-shaped curve and MC is also U-shaped curve, and MC always cuts AC at its minimum point. Here in the beginning AC start falling. When AC start falling, MC falls before than AC. After that, MC always cuts at its lowest point of AC. This is the intersection point where MC cuts AC. At this intersection point, AC and MC both are equal. Now, when AC start rising, then MC rises before than AC. So MC is more than AC in the third stage. In first stage, AC falls, MC falls before than AC. In second stage, when AC is minimum, now if we have given total cost like 50, 100, 128, 148, if we have given only two things, one is rate of output or quantity of output or units, and if we have given total cost, then we can calculate all types of cost with the help of these two things. One is total cost and other is rate of output. If rate of output is given and total cost like 50, 100, 128, 148, 162, 180, 200, 225, 254, 290, uh, 290, 350, 435, if all these total costs are given, then first of all we will calculate TFC. TFC, you know that TC curve always start from the point of TFC. That's why TFC and TVC remain same in the beginning. Then if TC is 50 unit, 50, then TFC will remain always constant or 50, 50, 50. So TFC is the first unit of TC. Now, how we can calculate total variable cost? Total variable cost is the difference of total cost and total fixed cost. If TC minus TFC, then we can calculate TVC. So TC minus TFC is always equals to total variable cost. 50 minus 50 is 0, 100 minus 50 50, 128 minus 50 78, 148 minus 50 98, and so on we can calculate. Now, marginal cost is the difference of total cost. Like in the beginning, if we are taking difference, then we must have to put in the beginning dash or the same unit of total cost like 50. And the difference of 100 and 50 is 50. 128 and 100 difference is 28. 148 and 128 difference is 20. 162 and 148 difference is 14. And so on we can calculate. Now, average fixed cost is called per unit cost of fixed factor, and AFC can be estimated by dividing TFC to Q. 50 is divided by 0, then it will be infinity. 50 is divided by 1, 50 आएगा. 50 is divided by 2, 25. 50 is divided by 3, 16.7. 50 is divided by 4, 12.5. 50 is divided by 5, then 10 will come, and so on. Now next is average variable cost. ABC we can estimate by dividing total variable cost to rate of output. 0 divided by 0, 1. 0 divided by 0 dash, and 50 divided by 1, 50. 78 divided by 2, 39. 98 divided by 3, 32.7, and so on. Now, average total cost we can estimate by using two formulas like first is AFC and ABC. The sum of AFC and ABC is equals to average total cost like 50 plus 50, 100, 25 plus 39, 64, 16.7, 32.7. The summation of this is equals to 49.3. 12.5 plus 28 is equals to 40.5. And the second formula, if total cost is divided by units or quantity, like 50 is divided by 0 dash, 100 is divided by 1, 100, 128 is divided by 2, 64, same. Answer will remain same. So AC or ATC can be estimated by using two formula. One is AFC and ABC summation, and other is TC divided by Q. We can estimate all types of cost if we have given only two things. One is total cost and other is rate of output or quantity. Next is, this is the formula of each and every cost of estimation, like total cost is equals to total fixed cost and total variable cost. AFC is equals to TFC divided by Q. ABC can be estimated by dividing total variable cost to quantity. ADC is equals to total cost upon quantity, or AFC plus ABC is also equals to AC. And MC is the change in total cost upon change in quantity, or change in total variable. If total cost is not given, then we can estimate marginal cost by using total variable cost change. So delta TBC divided by delta Q, we can calculate and see. Now next is sunk cost. You know that sunk cost is that cost which already occur and which already been incurred by past actions. They can't be recovered. They can't be changed. They are not relevant to future decisions. For example, if $400 spent last year to replace a water pump and $2 million spent 5 years ago on a new manufacturing plant, and if $1 million was spent on research and development 2 years ago. All types of these costs are related to past expenditures, past expenses, which can't be recovered at present. So, if the cost which can't be recovered, that type of cost is known as sunk cost. Next is what is the difference between private cost and social cost? There is a difference between private and social. Private cost is that cost which is bear by private entrepreneurs, and private cost is that money cost which incurred by a firm in producing a commodity. It does not include the effect of the produced commodity on the society, for example, externality. And social cost is that cost which is bear by whole of the society people, whole country people. And social cost is the cost of producing a commodity to the society as a whole. It includes real cost which is borne by the society directly or indirectly due to the produced commodity. Now, this cost is not included in the money cost of producing that commodity. For example, externality is the social cost. Externality generally refers to the effect of one person. If the action of one person affects the other, that is called externality. And it may be positive, may be negative. If private entrepreneurs using cost of production for the production of goods, and if they throw waste material, and if they throw garbage in rivers and other places, then whole society will bear this type of pollution like water pollution, air pollution, and noise pollution, etc. So the cost which is borne by or bear by whole society people, that is known as social cost. And the cost or money expenses which incurred in the production of any individual firm or business enterprises, that is called private cost. Now, next is economic and accounting cost. We have discussed earlier that accounting costs are the actual cost, are, and it also known as explicit cost or direct cost. And this type of cost involve money being spent, such as rent, utility bills, interest payment, etc. But the economic cost is the summation of explicit cost and implicit cost and opportunity cost. So the cost of alternative chosen and the benefit that the best alternative would have provided if chosen. So economic cost differ from accounting cost because it includes implicit, explicit, and opportunity. But accounting cost only include explicit cost, which is visible, but not implicit cost. Next is historical versus replacement cost. Historical costs are those costs of an asset acquired in the past, whereas replacement cost refers to the outlay means expenditures, which has to be made for replacing an old asset. So replacement is clear by its name that it's a replacement cost. If we buy one new asset instead of past asset or old asset, that is called replacement cost. If you replace old thing from new thing, that is replacement cost. And historical cost is that cost which is acquired in the past. So these concepts owe their significance to unstable nature of price behavior. Stable prices over time, other things given, keep historical and replacement cost on par with each other. Instability in asset prices make the difference between these two concepts. If prices are stable, then both will remain at par, and if prices are not stable or instability occur in asset prices, it makes the two costs differ from each other. So historical cost is that cost which is used for accounting purpose in the assessment of new worth of the firm, and the replacement cost figures in the business decisions regarding to the renovation of the firm. Next is money cost. Money cost is that cost in which all money expenses which incurred in the production of goods and services is called money cost or direct cost or explicit cost. And real cost is that cost which can't be measured in terms of money, but actually this type of cost generally occur while producing goods and services. Alfred Marshall calls real cost of production as a social cost. Real cost refers to the payment made for the production of goods and services to compensate for disutility or of rendering their services. For example, it is computed in terms of the toil, trouble, pain, sacrifices, discomforts, which can't be estimated in terms of money, but this is the real cost which is incurred in the production of goods and services. So, pain, sacrifices, all these costs are known as real cost. Now, this is the relationship between short-run cost curve. AFC is downward sloping curve, ABC is U-shaped curve, AC is also U-shaped curve, and MC always intersect all these types of cost curves at its lowest point. Now, next is relationship between AC and MC. We have discussed this topic. When AC falls, MC falls before than AC. When AC rises, MC rises before than AC. And at the point of intersection, both are equal. Now, relationship between AC and MC, we have discussed this. Now, long run versus short run cost curves. Long run cost curve is that cost curve which is related to long time period. You know that in long run, all factors of productions are variable. We can easily change all factors of production simultaneously. In long run, production law is returns to scale is applicable, and returns to scale has three stages: constant return, increasing return, and diminishing return. When there is a constant return, then cost will also remain constant. When there is a increasing returns to scale, cost will start decreasing. When there is a decreasing returns to scale, cost will start increasing. This is the derivation of LRAC curve with the help of SRAC curve. Here, different types of short-run average cost curves are given, and if we take the tangency point line, these tangency point line can derive this LRAC curve. This LRAC curve is known as long run average cost curve, which is known as planning curve, which is known as envelope curve. Like envelope, it covers all the short run average cost curves. Like short run average cost curve number one, if business plant has five, if any firm industry has five business plant, then we will draw short run average cost number one, short run average cost number two, second business plant curve, third business plant curve is SRAC 3, fourth business plant curve is SRAC 4, and fifth business plant curve is SRAC 5. And if we take tangent line to all these curves, which is tangent to these all short run average cost curve, then we can derive this long run average cost curve, which is known as envelope curve and planning curve. Now, next is SRAC, and different SRAC is very helpful for the derivation of LRAC curve. In the beginning, here cost is decreasing. That's why increasing returns to law scale law is applicable. When cost is constant, then constant returns to scale will be applicable. And when cost is increasing, then diminishing returns to scale will be applicable. And where both curve intersect each other, equilibrium point is determined. Now we can conclude from the today's session that the goal of the firm is to maximize profit and each and every firm wants to minimize the cost of production. So where cost is minimum and output is maximum, that is the main goal of the firm. Some costs are explicit, some costs are implicit opportunity, and a firm has some fixed and variable factor which is used for the production of goods and services. So this topic is completed now. Thank you.